Have you ever looked at a company's financial report and just felt completely lost? Like you're trying to read a different language? Well, you kind of are. And today, we're going to learn the grammar of that language. We're breaking down the fundamental principles of accounting, the hidden rules that shape how the financial story of any business gets told.
So let's kick things off with a pretty simple question. Let's say you buy a vintage car for $20,000. A year goes by, you get it appraised, and now it's worth $35,000. So, what's it actually worth? Is it the price you paid, or the price you could sell it for right now? This simple little problem, it gets right to the heart of a huge debate in accounting.
The answer to that question really depends on which accounting rule book you're playing by. Because, and you might not believe this, there are two completely different and totally valid ways to figure out what that car is worth.
And those two ways of thinking are called historical value and fair value. Just think of them as two different lenses you can use to look at the very same thing. One lens is pointed at the past, and the other is focused squarely on the present. Okay, so first up we've got historical value. This one's pretty straightforward. It says an asset is worth exactly what you paid for it, period. So in our example, the car's value is $20,000. Why? Because you have a receipt, a documented transaction. It's simple and it's verifiable. But then, on the other hand, you have fair value. This approach asks a totally different question. Hey, what could you sell this thing for today? It looks at the current market and says, nope, that car is worth its appraised price of $35,000. This gives you a much more up-to-date picture of its value. And right here, this is the big trade-off. Historical value, it's totally objective. You've got the receipt, you can prove it. But that $20,000 number, it might be completely irrelevant today. Fair value, though, is way more relevant, but it's also more subjective. I mean, what if a different appraiser gave you a different number? And it can be super volatile, bouncing around with the market.
So let's put this into a business situation. Imagine a company buys a piece of land for $100,000. Well, under the historical value rule, that's the number that goes on the books. Simple.
But then, maybe years later, a new highway gets built right next to it, and suddenly the land's market price, its fair value, is $250,000. So now you've got this classic dilemma. Do you report the price you can prove but is totally outdated? Or do you report the relevant price that's a bit more of a moving target? Businesses have to navigate this exact choice all the time.
Okay, so we've got two different ways to measure value. But that's not enough. To make any of this work, accountants all have to agree on a set of background assumptions. You can think of them as the invisible rules of the game. They're the foundation that everybody agrees on, just to make sure the numbers are consistent and we can actually compare them.
And here they are, the four foundational assumptions: going concern, monetary unit, time period, and accrual basis. Let's quickly break down what each of these really means. First up is the going concern assumption. This is basically just the default belief that a business is, well, going to keep going. It's not about to go bankrupt tomorrow. It assumes the company will operate for the foreseeable future, and that's what allows accountants to do things like plan for the long term instead of having to value everything at its "we're going out of business" fire sale price.
So let's say a company hits a really rough patch, has a terrible quarter. Accountants don't just throw their hands up and assume it's all over. Unless there is hard evidence that the company is about to liquidate, it's treated as a going concern. This brings some much-needed stability to financial reports.
Next, we have the monetary unit assumption. This one has two parts. First, you can only record transactions that can be expressed in money. So you can record the cost of a new machine for sure, but you can't record the awesome morale of your team, even if it's a huge asset. The second part is really important. It assumes the value of money itself is stable. We all know that inflation eats away at the value of a dollar over time, right? But for the sake of simplicity, financial reporting just pretends the dollar is a stable, constant unit. It's a practical shortcut to avoid doing some unbelievably complex math. All right, our third rule is the time period assumption. Look, a business could run for 50 years, and you can't wait that long to find out how it did. So this assumption lets us chop up that long, continuous life into nice, neat little intervals, like months, quarters, or years, so we can actually measure performance and make decisions along the way. This is exactly why you see public companies release earnings reports every quarter. They are literally applying the time period assumption, giving all of us a regular snapshot of how they're doing in these standardized little chunks of time. And finally, we get to the accrual basis assumption. And honestly, this might be the most important one of all. It says that you record revenue when you earn it, not when the cash finally shows up. And you record an expense when you incur it, not when you actually pay the bill. Here's the perfect example. Your company makes a huge sale in December, but the customer doesn't actually pay you until January. Under the accrual basis rule, that revenue gets recorded in December because that's when you earned it. This gives a much more accurate picture of how the company actually performed during that specific month.
Okay, so we've got these valuation methods, and we've got these 4 invisible background rules. But, so what? Why does any of this stuff actually matter in the real world?
Well, it all boils down to this: consistency and comparison. These rules make sure that everybody is playing the same game with the same rulebook. That way, investors can actually compare 2 different companies and know it's a fair comparison. Ultimately, all these rules work together to turn the total chaos of thousands of transactions into a clear, trustworthy story about a company's health. And that's what builds trust across the entire financial system.
Which leaves us with one last really interesting question to chew on. These rules create a clear, trustworthy picture, for sure. But if one of the main ways we measure value is subjective, and the very money we use to measure it is only assumed to be stable, then how real is that final number on the bottom of a financial report? It's definitely something to think about. Thanks for tuning in.